आपका स्वागत है. The topic for today's discussion is Takeover Defenses, Session 10 in Mergers and Acquisitions. Topic covered are introductions, types of takeovers, bailout takeovers, friendly and hostile takeovers, reverse takeovers, techniques of rates, defense against takeover bid, anti-takeover amendments, legal measures against takeover, and guidelines for takeover. Here we will be studying about various takeover defenses and different types of takeover. A takeover is generally involves the acquisition of certain block of equity capital of the company, which enables the acquirer to exercise control over the affairs of the company. In theory, when we talk about, the acquirer must buy more than 50% of the paid up equity of the required company to enjoy complete control. However, in practice, effective control can be exercised with a smaller holding, usually between 20 and 40%, because the remaining shareholders, though they are scattered and ill-organized, are not likely to challenge the control of the acquirer. When we talk about the types of takeover, it is very essential. There are basically three types. Alright, and before we discuss it, a takeover is the purchase of one company. So one company becomes the target company and the another company becomes the acquirer or the bidder who is in the picture to take over to buy another company, the target company. So there are three types of takeovers. The first one is bailout takeover. The second one is friendly and hostile takeover, and the third one is reverse takeover. So when we say bailout takeover, here very substantial acquisition of shares is done in a financially weak company to scheme of rehabilitation approved by the public financial institution. Here what happens, the lead institution would be responsible for ensuring compliances with the code. They would appraise the financially weak company, taking into account the financial viability and assess the requirement of funds for revival and transparency. The rehabilitation scheme, they have specifically provide the detail of any change in the management. So it provides acquisition of shares in the financially weak company, if any, in the following manners. The first one is the outright purchase of the share in public. The second is the exchange of shares. One company, the lead company and the rehabilitated company, they are all financially weak company, they exchange their share. And the third scenario is a combination of both. So the schemes, so far as possible, they must ensure that the proposed acquisition, here the promoter, they do not own any share in such a case where acquisition is made by new promoters to such scheme. When we talk about friendly and hostile takeovers, the name themselves suggest their features. So a friendly takeover, if the board feels that the accepting the offer serves shareholders better than rejecting it, it recommends the offer to be accepted by the shareholders. So these types of takeovers where where a bidder makes an offer to another company. It usually first informs the company's board of directors. It becomes a friendly takeover. A takeover is also considered to be hostile if the board rejects the offer but the bidder is continuously pursuing it. So it's a hostile in nature. The second situation where a takeover becomes hostile is the bidder makes the offer without even taking board of directors in the consideration. So in a private company, the shareholder and the boards, they are usually the same people and they are closely connected. So private acquisitions are usually very friendly. Because if the shareholders agree to sell the company, then the board of directors is usually the same mind or sufficiently under the control of the shareholders to cooperate with the bidders. Now when we talk about reverse takeovers, it is a type of a takeover where a private company acquires a public company. This is usually done at the instigation of a larger private company. The purpose here of being the private company to effectively float itself while avoiding some of the expenses and time involved in conventional IPO, right? Now when we talk about techniques of raids, so a corporate raid refers, it's a term for buying a large interest in the corporation and then using voting rights to require to enact measures directed at increasing the share value, which is sometimes also referred to as breaking a company. Alright, it also describes a particular type of hostile takeover in which the assets of the purchased company are immediately sold off. The measures might include replacing top executive, these are the raiding techniques, or downsizing operations, or liquidating the company. Here the management of many large publicly traded corporations react negatively to the threat of potential hostile takeover, right? So and they pursue very drastic or defensive measures, which are poison bills is one such example, or golden parachutes are the techniques that are used, and increasing debt levels on the company's balance sheet. Alright. Now what happens, a corporate raid means buying a large interest in the corporation and then using voting right to enact measures directed at increasing the share value. Now what are the measures that might include in increasing the share values? First we have discussed is replacing top executive. The second is downsizing operations, and the third is liquidating the company. Now there are defenses which are against the takeover bid. So a target company may undertake anti-takeover measures to discourage unfriendly takeover attempts. So one such measure is staggering the terms of the board of directors so that it may take several years to replace the entire board. A supermajority rule requires a supermajority of the shares, say for example 80 to 85% or 90%, to approve a takeover proposal. Once an unfriendly takeover attempt has been initiated, the target company's management has other anti-takeover measures that it can employ to deter the takeover. Alright, some of the very commonly used and proper strategies are poison bills. So what are poison bills? It is a scheme that could be triggered by a target company when a hostile suitor acquires a predetermined percentage of company stock. So to execute its defense, what the target company it grants all shareholders except the acquirer an option to buy additional stock at a dramatic discount. What happens? This results in diluting the acquirer's share and intercepts its control of the company. There is an example. In 1997 October, Pfizer, it's a pharmaceutical company, it issued new rights to stockholders to replace those that are expired on that date, issued 10 years earlier. So the board of directors reserved the ability to redeem the right at any time for a token amount. Another is divestiture. In a divestiture, the target company, it divests or spins off some of its business in the form of independent subsidiary company. So in such a situation, part of the company can be sold for cash or part of the company can be divested through a spin-off where share in the divested company are distributed to the shareholder. Another technique is white knight. So here it is a defensive strategy. The target company's management may seek out a friendly potential acquirer, which is known as a white knight. So if a white knight is found, it will offer an equal or higher price for the share than the hostile bidder. The possible motive for the management of the target company to do so is not to lose the management of the company. Here the hostile acquirer may replace the management. Another is golden parachute when we talk. Here the key executives and managers, they may be given golden parachute contracts in which they receive huge benefits in the event of a merger. Right? So in this situation, a company offers heavy compensation to its managers if they have to resign due to takeover. This reduces their resistance to takeover. Another is greenmail. So it involves a target company buying back its own share from the acquirer, but typically it is above the stock market price. So sometimes what happens, this repurchase can be very costly, but at least there is an agreement that the acquirer would not go for another takeover offer. When we talk about anti-takeover amendments, so in most countries where they have legal framework to regulate the mergers and acquisition activities. And when we talk about India, so M&A here are also regulated by the Companies Act 1956. There are also the Monopolies and Restrictive MRTP Act, the FEMA Act of 1997, and the Income Tax Act of 1961, the Securities and Exchange Regulation Act of 1961. So the SEBI here has issued certain guidelines for mergers and takeover acquisitions. So the Companies Act, when we talk about the Companies Act, it restricts an individual or a company or a group of individuals from acquiring shares together with the shares held earlier in a public company to 25% of the total paid-up capital. Also, it is to be noted that the central government needs to be intimated whenever such holding exceeds 10% of the subscribed capital. Furthermore, the Companies Act also provides for the approval of shareholders and the central government when a company by itself or an association of an individual or individual purchases shares of another company in excess of its specified limits. When we talk about when we talk about legal measures against takeovers, so the framework for regulating takeovers, it seeks to ensure transparency. The main purpose about ensuring legal measures is to ensure transparency, and even protection of shareholder interest और economic gains का भी एक major effect रहता है. Takeover के जो effects रहते हैं, it has its effect on the interest of many parties. Parties कौन से हो सकते हैं? The shareholder or contending acquirer. So if the process is transparent, because of the legal measures, all the concerned and regarded as legitimate device in the market for corporate control. In a takeover, the controlling, which often tends to be between 10 to 40%, right? It is usually acquired through market purchase. Typically, the controlling block, when we say, is bought at a negotiated price which is higher than the prevailing market price. SEBI, it has, many times it has come out with some guidelines on corporate takeovers. So the essential thrust of these guidelines is to take takeover as transparent as far as possible in order to protect the interest or the target company or the individual holders. So the essential thrust of these guidelines, again are to make the takeovers very, very transparent. When we talk about the guidelines for takeover, so first one is the disclosure. When we say disclosure, any acquirer who acquires shares or voting rights in a company which when aggregated with the existing stock, if such holding of the acquirer in the company exceeds 5%, 10% and 14% of the total, he shall disclose at every state of the aggregate of the holding to the company and to the concerned stock exchanges. When we talk about trigger point, here no acquirer shall acquire holdings which when aggregated with the existing stock of such holding of the acquirer in the company equal or exceeds 15% unless such acquirer makes a public announcement to acquire share through a public offer to the extended stipulated code. Offer price. Offer price to the public shall not be less than the highest of the following negotiated prices. So what are the negotiated prices? These are the average price paid by the acquirer or preferential offer price if made in the last 12 months. Another is content of public announcement. So it provides information about the number of shares proposed to be acquired, the minimum offer price, objective acquisition, date by which the letter of offer will be posted, and date of opening and closure of offers. Another is creeping acquisition. Here no acquirer together with person acting in connect can acquire more than 5% of holding in any financial year ending 31st March without complying with the open offer requirement if the existing holdings are between 15% and 75%. Payment of consideration. Here the acquirer must deposit in the account such sum as would together with 90% of the amount lying in the escrow account, if any, make up the entire sum due and payable to the shareholder as consideration for acceptances received and accepted, and for this purpose transfer the funds from the escrow account. Here the unclaimed balances which are lying to the credit of the special account at the end of 3 years from the date of deposit should be transferred to the Investor Protection Fund of the regional stock exchanges. There are two exercises for you. What are the defenses against takeover bid and what are the techniques of it? Thank you and have a nice day. Keep learning and relearning.